all of the experts and so-called experts tell us that tariffs lead to inflation, but you seem to have suggested already that inflation is, if not under control, close to being under control.
So inflation's in a really good place. It is definitely in a good place, and we have a forecast, and so does, by the way, every other brand name forecaster in the country, which is very similar to ours, that there will be some inflation from tariffs coming, not yet, but over the course of the coming months. And I think it's reasonable to expect that because the insight we have, and we're just kind of wanting to see more data on that before we move.
One final question about data. Our trade deficits with China, the EU, Canada, and Mexico have all significantly dropped recently. What does the data tell us about that?
Well, I think that's
how that would affect inflation.
How it would affect inflation. I don't know that it has implications for inflation, but it obviously reflects the tariffs. I think recently you've seen Chinese imports come down quite a bit.
Thank you. I yield back.
Thanks.
Senator Blunt, Rochester.
Thank you, Mr. Chairman and Ranking Member Warren. Chair Powell, welcome back. Inflation has come down meaningfully from its peak, and there are signs of moderation in the broader economy, but prices for rent and other essential services remain high, and the outlook is still uncertain. Wage growth remains strong, but productivity trends are mixed, and demand for places to live is high, but borrowing costs and material shortages are making it harder for builders to keep up, adding to the affordability pressures. And at the same time, while I know this is not something you would say, but at the same time, while our Republican colleagues are pushing for tax cuts for the wealthiest Americans that would expand the deficit, the administration's trade and immigration policies are also introducing uncertainty that may not yet be fully reflected in the economy. For families that I represent, the cost of living remains painfully high. Premature easing could have unintended consequences that undo the progress we've made. Later this year, the Fed will update its monetary policy framework to respond to today's inflationary environment. And after years of supply shocks, housing inflation, and fiscal volatility, I hope you will remain strengthened, the Fed's ability to navigate the more uncertain economy. And as you undertake this update, can you talk about how you're adapting the framework to these realities while preserving the Fed's commitment to full employment?
I'd be glad to. So we made changes in the year 2020 to our framework, and those were meant to take on board the special issues that a central bank faces during the era of extremely low interest rates, where rates were never very far from zero. In fact, we just barely got away from zero when we had to cut back to zero. And the feeling was very much that if we had any kind of a shock, we'd be back at zero for years on end again. And that's really not a good thing, because the economy can become very stagnant. So what's happened since then, the big thing is interest rates are back to much more normal levels historically. So our policy rate at 4.3% actually doesn't feel like it's particularly restrictive. So it's, in other words, rates have moved way back up. That means that the effective lower bound is less of a problem. It means that the changes we made in 2020 are less relevant. They're not completely irrelevant. So we're making modifications, which we'll be discussing inside of our committee between now and the next meeting and in the next meeting, that will return the forecast more to what it was before the 2020 cycle.
I know we had a chance to talk in the past about my focus on jobs and the economy and labor. And I want to follow up on Senator Kim's questioning, where the focus on the changing technology landscape and with artificial intelligence, generative AI, and just its impact on the economy and labor market. How would you describe AI's impact on the economy so far, and how is the Fed measuring it?
The effects of AI are probably not great at this time. Generative AI, and the question is, how great will they be, and how big will they be, and how quickly will that happen? And anyone who's been exposed to what AI is capable of has to be pretty stunned by what it's capable of. And this is even the early days too. You know, what the experts tell us is that, you know, in 2 years, these things that you're doing, that'll be nothing compared to what we can do in 2 years.
Hi, Mr. Wonderful here. You know, I don't waste time, and I definitely don't waste money. I joined Start Engine as a strategic advisor and a shareholder and a paid spokesperson years ago because I liked where this company was headed. And now, the numbers speak for themselves. Start Engine just posted a $30 million Q1 revenue. That's not a typo. That's 3x growth year over year. That's an incredible number. Here's the part you need to hear, though. They're still raising money, but this round only lasts until June. Now you can join the future of startup investing. Of course, it's up to you, but just remember, this round closes next month. Take care, my friends.
For worker displacement affect how the Fed defines full employment?
I don't know whether that's, I'm not the person to say how quickly that will happen. What's happened before with technology is it just seems to take a long time to be implemented. You know, there's the technology, what it's capable of, and there's what it actually does when implemented. That last phase has tended to take longer than people expect. Will it happen with AI? It probably will, but in terms of maximum employment, the Fed doesn't have the tools to really address the social issues and labor market issues that will arise from this. We don't have those tools. We just have interest rates, and you know, we'll always be able to balance the labor market so that supply and demand are in balance. But things like what AI does and what other things do from the outside, we just have to take them as they come.
Thank you.
Thank you. I yield back.
Yes, ma'am. Senator Tillis.
Thank you, Chair, for being here. Maybe just, I didn't expect to talk about it, but since AI came up, I mean, first off, we need to welcome it, exploit it, and benefit from it. I've had my staff try and go back and look at some of the congressional hearings in the times of the Industrial Revolution and other instances where we've had these threats of displacement, and it worked out okay for us. But the key is this is a global competition, and other countries are going to implement it. It is going to drive down their costs, and it will make us less competitive if we don't meet the challenge and become the innovator. But the transition is I think, very important to note. I want to talk about SLR for a minute. I think you all indicated the balance sheet's going to continue to shrink. We're not going to get to pre-COVID levels, which was, I think, somewhere around $4 trillion. So I guess the question is, you guys expect to hold higher levels of central banks to hold higher levels of central bank reserves than we have in previous years. Do you agree with that?
I don't think we'll get all the way back to where we were, but we're still shrinking.
Is it fair to say that the SLR should be updated to reflect the evolving preference?
Yes.
Thank you. Fed now. It's cost $545 million. You know, Chair Powell, I've never really liked Fed now, so it's probably not a friendly question. But I spent $545 million to implement it now. I think you're expected to spend another $245 million in 2025, so the total price tag is $1 billion. As you know, the Money Control Act requires the Fed to cover all the direct and indirect costs actually incurred. So can you give me an idea of when we're going to see a fee structure that's going to generate and actually pay for this implementation, including the expected ongoing operational cost?
So you're right. That is our obligation under the law is to have it be self-funding, and we have a period during which that's supposed to happen. Yeah. Uptake has been steady but not rapid, and usage has been. Is it your sense
that you're going to be able to get to that, and that the fee structure that you're going to need based on that take rate is going to be achievable?
I think it's probably still achievable. I am not 100% clear that we're going to achieve it very soon.
That'd be it. Yeah, that's what I'm concerned. And I wonder if that pricing is there, given private sector options, if you're ever going to be able to get there. So just an editorial comment. One thing I did want to mention, I'm excited to see some of my colleagues on the other side of the dais concerned about the debt. Because last time I checked, over the 4 years that President Biden was in office, we had the American Rescue Plan that cost us $2 trillion. We had the Inflation Reduction Act that cost us $1 trillion. And we had the PACT Act that many of my colleagues, I was one of 9 Republicans that didn't vote for it, that also cost us $1 trillion. So I'm excited to see that my colleagues on the other side of the aisle want to get serious about spending within our means. I did have a question, I think, on for my staff wanted to ask about, sorry, I just want to get my notes right. I actually wanted to go, I don't have it before me, but what's the current status in your view on Wells Fargo's capital requirements?
On their capital requirement, well, on the, you mean on the, I think you mean on the growth cap?
Yeah.
Yeah, so we voted unanimously to remove that after many years of having it in place. They did satisfy the requirements we'd put in place, and we removed the cap along with the other agencies.
And you think your fact-based decision, you stand by it?
I do.
Very good. Last thing is Walmart, I've got other questions I'll submit for the record, Chair, but Walmart on April 9th, I think, withdrew their forward guidance. And they indicated the reason that they were doing that is there was uncertainty, and it seems to have been timed somewhat with the uncertainty around trade. So I would just suggest for my colleagues, I don't know if you can respond to this or not. I won't ask you a tax question, but I really want to. But I know what your answer is going to be. You're a good dancer. I think that it is fair to say that if there is going to be a correlation to increasing prices, and Walmart having made the decision to withdraw their guidance is probably the best testament that they know that they may have to deal with cost and maybe inflationary uncertainties. Would you characterize that as maybe a likely reason that they withdrew their guidance?
It might be. You know, I saw that they had. I didn't have a chance to go back and check why.
Well, if you tease through the language, it seems almost certain that they think that some of their input costs were going to go up, and they need to manage their margins. So I'm just telling my colleagues, you know, we just need to be realistic that if you have a major household name withdrawing guidance because of uncertainty, they've got a lot of experts that probably are suggesting there may be some inflationary risk. We haven't realized it yet, but I think we all need to keep our eyes open and not look past it so that we can manage it if it comes to pass. I don't think that there should be a problem with that.
Thank you.
Now, the last thing that I just want to mention is that you can't respond to this, but I will tell you, if the Democrats succeed in preventing us from avoiding the biggest tax hike in the history of this country, it is going to cause great damage to the people who can least afford it. You don't get to respond to this one, but folks.
Senator also Brooks is next.
Oh, I'm sorry. I didn't realize she was here.
Yes.
I'm sorry.
We were allowing
but
him
we
to
need to
stall
open
till
that.
you
We
got
need to be open. We need to understand that you will have something to fix if we fail to continue the tax cuts.
Thank you, sir. Senator also Brooks.
Thank you so much. First to Chair Scott and Ranking Member Warren, thank you so much for hosting today's hearing. We thank you also, Chairman Powell, for your tremendous service to our country. I very much enjoyed the meeting that we had earlier this year and look forward to working with you. Many of my colleagues today have been listening to this hearing, have rightly discussed concerns regarding how tariffs are affecting consumers and businesses. And I'd like to highlight a specific business in Maryland that encapsulates the harm that I believe this administration is inflicting, but also the resilience of a proud Maryland small business. BayDog is a successful pet brand based on Kent Island, one founded by Barton O'Brien, who's a Marine veteran who served 3 combat tours overseas. Mr. O'Brien has calculated that if he were to make his products in the United States, he would have to raise his prices 400% just to break even. The tariffs, he believes, are a burdensome tax that could put companies like his out of business, but the damage doesn't stop there. BayDog is sold in thousands of other brick and mortar stores across the country, all locally owned small businesses who similarly have to raise prices or lose sales to pay the president's tax. Mr. O'Brien started planning for this last summer when President Trump started talking about tariffs during the campaign. He stockpiled inventory and has committed to keeping his prices stable this year. But what BayDog is asking is what is he to do if the tariffs are in place next year? Mr. O'Brien has calculated that he won't have to just raise prices. He'll likely have to cut his staff to stay in business. So Chair Powell, there are 34 million small businesses in America, one for every 10 people. And if small businesses like Baydog have to lay off staff or go out of business altogether, what will that do to unemployment in this country, and what effect will that have on the broader economy?
I mean, just mechanically, I don't want to comment on particular tariff policies, but sure, if companies go out of business, then that'll hurt employment and activity.
And what we will see is, of course, and we have so many small businesses, what we're facing now is that very prospect, is that we're going to have so many, and we believe that, you know, the inflation caused by these tariffs will really have a very negative impact. And if this is the case, what would this mean for American workers?
Well, the other thing is I think the tariffs are still in motion. You know, it's premature to say exactly where they're going to land. So we're kind of withholding judgment until we see more. That's kind of where we are. We haven't made a decision to do anything. It's just we want to see more. And the situation evolves day by day, month by month. So.
Okay. Well, in another question, in our meeting and in your most recent monetary policy report, you spoke of the long-term challenge of housing supply not meeting demand. And I look at this issue the same way I did as county executive, where I really fought hard to leverage private and public sector dollars to bring more housing to communities that needed it. Maryland has a shortfall of nearly 100,000 homes, and the pathway to build wealth is therefore narrowing. So studies have estimated that of the over $200 billion invested annually in housing in recent years, only a fraction supports affordable homes for working class families. So would you speak to the need to better incentivize private investments into affordable housing construction? I'm working with a private sector and nonprofit stakeholders on legislation now, but just wanted to know if you could comment on that.
So I would say this: interest rates are you know, slightly restrictive at this point, modestly restrictive, and that is weighing on economic activity in the housing market sector. But you're really talking about a different problem. It's not one that the Fed can really address, and that is we have a longer run housing shortage. So many other advanced economy countries have this too, and it's not our tool. Our tools don't really work to affect that. It's really elected people, and you saw this as county executive. It's things that the legislature can do that can really address that. Not us. It's not about interest rates.
All right. Well, now I understand one other issue. The Fed is evaluating the leverage ratio rules regarding the amount of capital required to be held by banks to withstand unforeseen risks. And I'm hoping you can then provide some insight as to what potential changes this framework are meant to achieve. On the other hand, I understand that access to capital is paramount, particularly for communities I represent. So, and I understand concerns that a change in these requirements could affect the resilience of the banking sector. Though I know you cannot speak to the specifics of the coming proposal, would you share some insights into what problem the proposed rulemaking is meant to solve, and are you concerned that it could lead to a deterioration of resilience of the banking sector?
I'd be glad to. So the idea behind it is that we want risk-based capital to be the binding capital requirement, because we want the binding capital requirement to be, we want banks to be sensitive to the risks that they're taking. If the leverage ratio is not risk sensitive, it treats every asset as equally risky. So if that's binding, then that interferes with banks' incentives to manage their risks and actually discourages banks from taking on relatively low risk activity. So we've always at the Fed wanted the risk-based capital to be the binding one and the leverage ratio to be the backstop. And so that's this proposal that we have that we're going to be meeting on in a couple of hours puts out for comment a proposal to restore the the backstop characteristics of the leverage ratio. We think it should make it will not in any way diminish the safety and soundness of the financial system, and it will allow for banks to undertake lower risk. Thanks.
Thank you so much. Thank you, Mr. Chair.
Yes, ma'am. Thank you. For senators who wish to submit questions for the hearing record, Those questions are due 1 week from today, Wednesday, July 2nd. Chairman Powell, you have 45 days from that day to submit your responses to the questions. For the record, thank you for being here. This committee is adjourned.
Thank you.
My parents worked hard for everything we had. They taught me the value of a dollar and how to use it wisely.
Some things are hard to commit to, like decluttering your attic. Ow! Learning how to play the ukulele. Or doing anything after 8 p.m. because your couch is calling. But one commitment that's easy, switching to Fios Home Internet with a 3-year price lock guarantee. Plans start at just $35 per month with no hidden fees or equipment charges. Click or call 1-833-VERIZON to switch to Fios Home Internet today.
Without the ones like you working tirelessly.